Bismillahirrahmanirrahim and Assalamualaikum to Madam Nur FAIZA. Today our group will present on the corruption of Enron Corporation. This is my group members. The first one is Nurdini ANATASHA binti Abdul Aziz. Second, IDZATI KARMILA binti IDRIS. Third, Jamaahtul Syuhada binti ZULKIFRY. And AMANI binti ABDUL HAFIDZ.
Hi, Assalamualaikum. I'm AMANI binti ABDUL HAFIDZ, the first presenter for this video. We're presenting about the company background of Enron Corporations. First thing first, Enron Corporation, known as American Energy, Commodities and Services Company located in Houston, Texas. This company was founded by Kenneth Lay in 1985. Enron was the leading supplier of natural gas, communication, pulp and paper and has been received the America's most innovative company for the 6 consecutive years. Next, I will explain about the Enron scandal through the timeline. So, in 1985, there is a merger between Houston Natural Gas Corporation and the Internorth Inc., which is resulted in the formation of the combined entity of Enron Corporation. At that time, Ken Lay was the CEO of Houston Natural Gas and he continued as the CEO of Enron. Then, in 1990, Ken Lay hired Jeff Skilling as an advisor from McKinsey and Company, which are the consulting company that advising Enron in the business. Next, in 1992, Jeff Skilling devised a new account technique called mark-to-market, by which he can adjust the value of an asset on the balance sheet from historical cost up to fair value and got the under revenue. This way, we allow him to capture the projected revenue from the plan as a current revenues. Believe or not, it is approved by SEC. This mark-to-market technique basically has increased their stock value. Then in 2000, Enron entered the deal by Blockbuster to provide a video on demand service. For example, something like a Netflix, but this time such technology does not exist yet. Enron used mark-to-market method even though the service has not provided yet because of the limitation of technology, which caused a bankruptcy to Enron as the cash inflow does not match with the revenues in the balance sheet. The bankruptcy has been declared by Enron in 2001.
Hello, my name is DINIE ANATASHA and I will continue with the risk management issues of Enron company. The first risk management issues that extract from the Enron case is that the risk of the company's innovation were not properly addressed or poorly determined. So the terms of innovation by Enron company here is that Enron company instructs the tax department to produce billions of dollars through the complex tax shelter. It means that there was an illegal investment that claims to reduce the income tax liability without changing the value of the income or the asset. Basically, the Enron company was facing the high risk as stated by subcommittee, since the company's tax department makes the investment from the accounting and loss company to increase the profit of the company. So this innovation that primarily for the purpose of gaining the income is not properly addressed by the management, since there will be risk that the company will have to face, which is the company have to deal with the legal risk and fraud risk due to the illegal investment as well as the incorrect reporting that presented. So for the second risk management issue is regarding the accounting practices applied. Basically, all the Enron board's members were well aware and support the Enron strategy, which aimed at maintaining its investment credit rating, increasing the cash flows and reducing its debt burden. But in the issue of the project and Enron's board, the subcommittee found that Enron has the high-risk accounting practices in any transaction. So clearly, here proof that the board were well informed of this and took no action to prevent the Enron from practicing it. To be more worse, the board also did not investigate the transaction, not even overseeing the company operation, and did not hesitate in approving the new business ventures and approve the complex transaction. For example, even though the board also was briefed on the purpose and the nature of Whitewing LGM and read the transaction, but explicitly approved them and received the updates on the operation. Plus, the Enron's extensive off-the-books activity was not only well known to the board, but was made possible by the board resolution. So here shows that there is a lack of ignorance of risk management regarding the accounting practices by the Enron. Alright, move to the third issue is that the issues in approving the inaccurate and deceptive report. Actually, the board was warned on the risk of accounting scrutiny in performing the transaction at the Finance Committee. However, the board completely neglected the red flags. So, in this case, the Finance Committee approved talent on basis of an inaccurate and deceptive risk management report. It is where the report stated on the counterparty credit and its mitigant is asset of vehicle subject to a master netting agreement. This is actually a false statement because the risk of counterparty credit and the inability of Enron to recover its net money position against talent are not mitigated by netting. It only protects Enron from talent's decision to select the best investment company during bankruptcy. However, since the committee approved it, this means that the committee approved a bad business deal on basis of an inaccurate and deceptive risk management report. And this is due to the poor monitoring of risk management report and the ignorance by the board which lead the company in accepting the identified risk. The deal also caused the company to lose their sufficient credit quality.
My name is IDZATI KARMILA BINTI IDRIS. I will continue with the fourth risk management issue in Enron, which is creditworthiness risk. This risk falls under financial risk. It was the lack of creditworthiness of the Raptor Project SPE, which is special purpose entities, that forced Arthur Andersen to withdraw its endorsement. This resulted in Enron's restatement of its financial reports, showing significant charges against earnings and reduction in shareholder equity. This triggered Enron's credit rating downgrades and its eventual bankruptcy. Because of the creditworthiness risk, this was a bad business deal, even had they not been the product of legal and accounting evasions. And even if Enron was not covering the SPE's losses, the Raptor SPEs had a structural defect. This risk led to the Enron's collapse. The fifth risk is extensive undisclosed off-the-books activity. This risk is considered as fraud risk. The Enron Board of Directors knowingly allowed Enron to conduct billions of dollars in off-the-books activity to make its financial condition appear better than it was and fail to ensure adequate public disclosure of the material of the books liabilities that contributed to Enron's collapse. What turned the Enron case into a major financial scandal was the company's response to its problem. Rather than disclose its true condition to the public investor and as the law required, Enron falsified its account. It assigned business losses and near worthless assets to unconsolidated partnerships and special purpose entities. In other words, the firm's public accounting statements pretended that losses were occurring not to Enron but to the so-called Raptor entities, which were ostensibly independent firms that had agreed to absorb Enron losses but were in fact an accounting plot created and entirely controlled by the Enron's management. In addition, Enron appeared to have disguised bank loans as energy derivative trades to conceal the extent of its indebtedness. The last risk management issue in Enron is incorrect accounting methodology that falls under reporting risk. It was disclosed in October 2001 where a $1.2 billion reduction in shareholder equity, which arises from an incorrect accounting methodology that Enron used for the Raptors, which Andersen had advocated but later decided was in violation of generally accepted accounting principles and had to be changed. Investors reacted to this disclosure by selling Enron stock, causing a further decline in Enron's stock price. In November, a proposed merger with DINIE failed. Credit rating agencies then dropped Enron's rating below investment grade, and it collapsed into bankruptcy.
My name is Jamaahtul Syuhada binti ZULKIFRY, and I will present regarding the roles of Board of Director and Audit Committee that leads to the corruption of Enron Corporation. For the first part, I will explain regarding the roles of 4 different protagonists. 3 of them were Enron Executive, CEO and Chairman Kenneth Lee, COO Jeff Skilling, who became CEO a half year prior to the company's demise, and CFO Andrew Fastow. Arthur Andersen, Enron's auditor, was at the time one of the so-called Big Five, the 5 largest auditing firms along with Deloitte, PwC, Ernst & Young and KPMG. The second part is regarding the roles of executive officer. First, fiduciary failure. Enron's board of directors allowed the business to engage in high-risk accounting, inappropriate conflict of interest transactions, massive undeclared off-the-books activity, and excessive CEO compensation, of all which contribute to the company's demise. Many warning signs were present for years, but the board decided to disregard them at the expense of Enron shareholders, employees, and business partners. Second, inappropriate conflict of interest. Even though there were clear conflict of interest, the Enron Board of Directors agreed to a first-of-its-kind deal that let Enron's Chief Financial Officer set up and run the LGM Private Equity Funds, which did business with Enron and made money at its expense. The board didn't keep a close enough eye on LGM transaction and compensation controls, and didn't do enough to protect Enron shareholders from being treated unfairly. Third, failure to avoid conflicts of interest. The conflict of interest were clearly shown when the CFO was approved to become the sole manager and also the general partner of LMG1, allowing him to make millions of dollars by performing Enron swap sub transactions. Failure to avoid conflict of interest is explained by the corporate culture, which is one of the cutthroat competition between the employees. In this way, Enron's culture might be seen as a risk-taking, one that placed an excessive amount of dependence on Andrew Fastow. Because of this, he was able to reap the benefits of his schemes. The failure may have been caused by the board's own conflict of interest, considering that Fastow made millions of dollars from the Enron self-deals transaction. Moving to the third part is regarding the role of the audit committee. First, conflict of interest. The audit committee members indicated that they had thought Andersen and Enron had a good working relationship and taken great comfort in knowing that Andersen was more than Enron's outside auditor, but also provided Enron with extensive internal auditing and consulting services, combining its role into what Enron called an integrated audit. Due to this, Andersen might be working audit its own work, and that Andersen auditors might be reluctant to criticize Andersen consultants for the LGM or Raptor structure that Andersen had been paid millions of dollars to help in design. Second, lack of competence. Arthur Andersen failed to examine extremely complicated financial vehicles designed by its client's management. Regardless of the reasons, Arthur Andersen failed to produce a quality audit report, and the action of shredding tons of Enron's document reflects its failure to fulfill its fiduciary duty.
So as a conclusion, every company need to have a framework of internal controls. This because internal controls will ensure the integrity of financial statements. Then the management has to sign off of the integrity of the financial statements and the effectiveness of its internal controls, and the auditors should not only sign off of the financial statement of the company, but also must sign off the effectiveness of the company's internal controls. Those are stated in Sarbanes-Oxley Act 2002. Next, the lessons learned from the Enron scandal is the accounting firm should not be paid consultants and perform the auditing of a company's financial reports. This because in order to avoid a conflict of interest. Secondly, revenue should be recognized when it is earned and not based on the future earnings projections. And how the company earns its revenue should not be hidden from the investor. In a nutshell, Management must work together with the internal auditor to design the effective and efficient internal control for the sake of company's stakeholders. So that's all from us. Thank you.